All right, let's dive into the latest numbers from a company you probably have in your fridge right now, Fraser and Nave, or FNN. They've just dropped their Q3 2025 results. And trust me, there's a really fascinating story brewing just beneath the surface of the headline numbers.
So let's just get right to the heart of it. The big question that really jumps off the page when you read their report. What in the world happened to FNN's profits this quarter? Because at first glance, things look, well, a little rough.
Take a look at this. Profit before tax clocked in at just over 131 million ringgit. Now, compare that to the same time last year when it was over 170 million. That's a drop of almost 23%. So what's going on? Is the business in trouble? Well, the real story is all in the why. Okay, before we get into the details, let's just do a quick scan of the main headline numbers to get a feel for the quarter. And yeah, you can see it's a sea of red right across the board. Revenue slipped by about 4.5%. We already saw that nearly 23% drop in profit before tax. And of course, that just cascades down. Profit after tax fell over 30%, which means earnings per share took a similar hit. So, yeah, definitely a tough quarter on the surface, but this is just the high-level view. To really understand what's happening at FNN, you have to split the company in two. It's truly a tale of two very different regions. Their food and beverage business in Malaysia and their business in Indochina. And you can see just how important both are. The business is pretty much sliced down the middle. Malaysia brings in about 54% of the revenue, with Indochina right behind at 45%. They're two massive critical engines for the company. Now let's see how each one is running. So starting at home in Malaysia, revenue here was down 7%. The company says this is down to a couple of things. Demand kind of cooled off after the big holidays, and shoppers are generally being a bit more careful with their money. Makes sense. But hold on, because the profit story in Malaysia, this is where things get really dramatic. Operating profit plunged by 65%. Now, the lower revenue was part of it, for sure. But the main reason, the key to this whole quarterly report, is something they call significant startup losses from the new dairy farm. Remember that phrase. We're going to come back to it.
Now, let's switch gears and look at Indochina. That's places like Thailand and Cambodia. Their revenue was also down, but look, only by a tiny 1.3%. That's basically flat. And that's impressive, especially when you consider they had their own headaches, like nervous consumers, less tourism, and even border closures.
So you'd think, okay, revenue's a little down, profit is probably down too, right? Wrong. And this is the big twist. Operating profit in Indochina actually grew by almost 9%. How did they pull that off? They were smart. They cut back on promotional spending, and they didn't have a one-off debt issue that hit them last year. This strong performance in Indochina is a really bright spot in the FNN story right now. Okay, so we've pretty much pinpointed the problem child affecting the profits, those big startup costs in Malaysia. But that leads to the next big question. With all this cash going out the door for a new project, how is the company's overall financial health holding up? Let's follow the money. First, a super quick explainer. When we say startup losses, it's really just business speak for all the money you have to spend on a massive new project like FNN's new AgriValley dairy farm before that project is actually up and running and bringing in its own cash. It's the classic idea of spending money today to hopefully make more money tomorrow. And the company's cash flow tells this story perfectly. Just look at this. Over the last 9 months, their normal operations churned out a really healthy 474 million in cash. But where did that cash go? Well, they turned right around and spent 480 million on investing. And you can see that huge chunk, 453 million of it, went directly into property and equipment. Yep, that's the dairy farm. And on top of all that, they still paid out 286 million, mostly in dividends, to their shareholders. All that heavy investment is making the company physically bigger. You can see its total assets have grown to over 5.7 billion ringgit. Now, of course, to pay for that, their liabilities have gone up a bit too, but the main takeaway here is that they're building a much bigger foundation for the future. And here's the crucial point. Despite that scary drop in profit for the quarter, the actual underlying book value of the company is going up. The net assets per share have climbed from 975 to 1022. This tells you that those investments are, at least on paper, adding real, tangible value to the company. Okay, so we've diagnosed the situation. Now let's talk about the strategy. How is management planning to steer the ship through all these challenges and actually turn those big investments into big profits down the road?
They are definitely juggling a lot of moving parts. It's not like they're operating in a bubble. In Malaysia, you've got tax changes. We already talked about the border issues and nervous consumers. And then, layered on top of everything, are those bigger worries about global politics and tariffs that could affect their business anywhere. But that big strategic project, the AgriValley, it's not just a negative number on a spreadsheet. It's a real project that's gaining serious momentum. You can see it here. The first cattle arrived back in March. They actually started commercial milking in May, and the huge processing plant right next door is on track to fire up by the end of this year. The path from spending money to making money is getting clearer every day. And they're not just waiting for the cows to do all the work. They're actively innovating to keep up with what you and I want to buy. They just launched a whole new line of plant-based milks, oat, almond, even some cool soy blends. It shows they're playing offense and trying to capture new markets. So after digging through all the numbers and the strategy, what's the bottom line? What does all this really mean for anybody keeping an eye on FNHB? Let's just boil it down to the key points. First, yes, profits are getting squeezed right now, but it's mostly because of a huge strategic bet on the dairy farm, not because the core business is broken. Second, that Indochina segment is an absolute star, showing it can make money even in tough times. Third, management seems to have a clear plan, navigating risks while pushing out new products. And finally, there's a visible pipeline for growth, not just with the dairy farm, but with another new plant coming in Cambodia. Which leaves us with this final, forward-looking question, doesn't it? The company is making a very conscious choice to sacrifice some profit today for what it hopes will be a massive payoff tomorrow. But will these huge bets, especially this all-in move on the integrated dairy farm, actually deliver the kind of growth needed to make today's pressures all worth it? That is the billion-dollar question we'll all be watching in the quarters to come.